Hello everyone, welcome. This is Satish Kumar. I'm here with another lesson on Indian economy, and in this lesson we are going to learn about the Indian capital market. So in the previous lesson, uh, in the financial market topic, we learnt about the money market. This is a continuation of that. Okay, we will learn about the Indian capital market. See, we discuss the definition of what is a financial market and what are the is the money market and what is the capital market in the first class itself. Okay, so in this lesson we are going to learn very specifically the different types of instruments available in the capital market that are traded in the capital market. Okay, so we know what is capital market, so we are not going to what is capital market. But generally in the capital market, the people who wants fund and the people who has fund lend for a longer duration, that is above 1 year. Okay, so here different types of instruments are bought and sold, like stocks, bonds, debentures. So these are all bought and sold for a long period of time. So we will study today what is stock, what is bond, what are I'll say features, debentures, derivatives, right? We will study all these things in today. Okay. So the capital market consists of two types. One is primary market, where the fresh issue of a security will take place. For example, if you take a company issuing shares, in the primary market there will be the initial public offering and also the follow up of public offer. In this there will be relationship between the company which is issuing the shares and the investors. There is also the secondary market, but in the secondary market what will happen is the previously issued securities, they will be traded between different investors. For example, a person who had bought a the share from a company might want to sell that share to some other person, so he will sell to another person. Okay, so this kind of transaction market is called as secondary market. Okay, I hope you understand what is the difference between the primary market and secondary market. Okay, see, we need to know why capital market is very important. In fact, capital market, in fact especially the equity market, it has led to large corporations to come. In fact, without capital market developing properly, a country will be underdeveloped and or not well developed. The capital market serves the purpose of a country to have more industries, more investments and more job opportunity, everything. Okay, so the capital market it also increases the saving of the people. Okay, so this market is very important. Okay, because it provides a platform for people who have money to invest and to earn money on that. And generally you might ask, there is bank, people could invest in bank and they could earn there also. But the problem is, when you invest in bank you will get some returns which may not be higher. But in the capital market, if you invest, there will be more profit. Okay, that's why people invest in capital market. And this gives and the different types of capital market that have come today, offers the people who want to invest variety of choice. Okay, so rather than simply investing in a bank, they have a lot of choice, okay, and there is also options for them to earn more, okay. That is why capital market is so very important on the investor's point of view, okay. They'll earn, if they invest in a share, they will earn dividend, they will become a shareholder of the company, okay, owner of that company, okay. And generally the types of return that they get from the instruments of capital market are far higher than the interest rates given by the banks, okay. And these instruments are some instruments are also having tax benefits. When you invest in a stock market, no, that is tax deductible. So these kind of thing, okay, such a thing. So investors have so many benefit in the capital market, and it also provides the people who want money to raise capital, okay. In fact, as I said earlier, no, without the capital market, we would have not have seen such a large companies. Not everybody is having that much of amount to start a business and to enlarge a business, okay. Small companies, medium companies, how they become big? They can become big only by these kind of instruments, selling these kind of instruments in the capital market and raise money. Even the government need money to do its job. So the government also uses this capital market to raise money, okay. In fact, in India, our government is using our capital market, the financial market, so much that it want to raise money from that, okay. So everybody needs money. This purpose is served by the capital market, okay. See, initially there was only banks. In fact, all countries, initially the banks is the only source for credit availability for capital market. But later on, and a lot of things have developed, and in these days we have variety of instruments, like insurance industry is there, there is stock market, there is mutual funds, okay. And today we have a very vibrant stock market in India itself, okay. So this provides a variety of segment for companies to raise fund, okay. So that is also very important purpose served by the capital market. And it is not a very easy thing to develop a capital market, and it requires a lot of regulatory framework, and this is done in India by the SEBI and other things, RBI and other things, okay. So it is an ongoing process, but we have a very sound capital market in India. It is a growing one. It is not as good as USA and all that thing, but we have a stock market which is growing each and every day, okay. And this stock market, a vibrant stock market, is a good sign for a developing an economy that is fast developing, okay. And when there is this capital market sound, no, it will bring lot of benefits, growth benefits to the country. The economy will prosper, there will be more employment, there will be more jobs, large number of companies coming, all these things will go towards this, okay. That is why the capital market is so very important. See the evolution of Indian capital market. See, India capital market is stronger today, as I said earlier, but it was not that good during independence. In fact, at that time, even the bank itself was not there. Even the bank was so weak, okay. In fact, during independence, India was 85% agriculture economy, and there is no industries, okay. In fact, for the industrial development, India decided to become an industrial country. In fact, industry will be the prime moving force for our economy to grow, no. We have set that goal, but the problem was, where would the fund will come to these industrial establishments? Because at that time the banks are not that strong. they are very weak and small and geographically unevenly distributed, so they are not in a range to provide this kind of credit to the industrial sector. So the government decided to set up financial institutions, okay, at the time of independence. So we set up lot of financial institutions which would provide project financing, and government fund will be used for this industrial development. That is how India started industrial development until the bank becomes stronger. Okay. In fact, so the initial time it was done by the financial institutions created by the government and the project financing. Okay. So the government itself did. That is what it is written here also. Okay. But over the time, the Indian capital market started to develop all this in different sectors. For example, banking becomes stronger over the period of time. Okay, after nationalization, banks started increasing their asset, so they are lending more. Then the financial institution which are earlier created was also there. Then came the insurance industry, and last but not least, the security market and the equity market. In fact, equity market is part of the security market. So with this, we have, in fact, security market is considered at this time as the major source for capital market. Okay, more than banking industry and other things. Okay, so they are contributing a lot towards development of capital market in India. Okay, in fact, that is the major segment of the capital market in India. So we have already learned about the banking industry. In that, we also learned about the financial institutions. We will learn about insurance in the next lesson. In this lesson, we will focus more on the security market. What are the different types of security instruments available? What are the different types of capital instruments available? In fact, this is the major area. Okay, we will learn about the debt market and the different types of instruments available. We will learn about the derivative market. We will learn about the commodity market, and we will learn also about the equity market. Okay, in fact, all this cannot be covered in a single lesson, so I will be putting a separate second lesson also, part 2 also. Okay, today we will see the debt market. Okay, so there is this wholesale debt market of National Stock Exchange, and it provides the platform for a wide range of securities. Okay, and this wholesale debt market deals with both the money market instruments that we learned in the previous lesson, no, and it also includes the capital market securities. Okay, so debt instruments, it's nothing but a contract between one person who wants money and the other person who is lending money. Okay, and debt instrument is nothing but a contract. So that in that contract, it will be predetermined terms will be there. Okay, for example, a person, for example, take a case, one debt instrument, bond. Okay, one person is issuing a bond. For example, Indian government is issuing a bond, saying that this is 1,000 rupees worth bond. Okay, you pay me 1,000 rupees and we will give you this bond. So the investor, that is you or me or a company, no, or a bank, they will buy that bond for 1,000 rupees. Okay, that is a predetermined price. The bond is a predetermined price, and they will also fix a rate of interest for that. For example, for 1 year, 10% interest. Okay. Here, please remember, here what is the thing is, they will get regular interest, and finally at the end of the time, the bond will be repurchased by the seller, the bond issuer. Okay, so the person who's investing, no, is getting regular intervals, there is getting some interest, and finally is also getting the money, and this is a very good investment opportunity. Okay, so there are some major instruments of debt instruments like bonds and debentures. Okay, we will see these two in detail. Okay, so bond, what is bond? Okay, so this is a loan given by a buyer to the issuer of an instrument, the bond. For example, I have already discussed just now. Okay, a government is issuing a bond. Okay, so different types of people can issue a bond. For example, a government issues bond. In fact, we have learned, no, government will issue bond called dated securities. Okay, in fact, it is called G securities because it is known as gilt securities. There are two reasons why it is called gilt securities. One is those bonds will have that edged in a gold color those things. It will there will be a line crossed in that bond in the gold color edge. Okay, there will be in that bond. That is why it is called gilt edge. In the edge there will be some gold color thing. Okay. The second reason is these bonds are highly safe for investment. You will not lose the money because it is the government bond. So these two reasons why it is called G securities. Okay. In fact, most of the people will be willing to invest in the capital market in the G securities because it offers a safe amount, safe for investment. It is safe for investment, and it is also offers some regular profit. Okay, that is the reason most people will invest in this. Okay, so the holder of the bond will get at the end of the period. So for example, if a government, if India wants to raise 10-year loan, what it will do is it will issue a bond, say that this bond is 1 lakh rupee. Okay, and the person who is lending amount to the government will give that 1 lakh, and the government will issue that 1 lakh bond, and at the end of the 10-year period government will repurchase that bond at that price. Okay, and when the government price, it will price at that point par value. Okay, so there is this difference. In fact, we learned in the previous class, the bond value and bond yield. I will discuss about in a separate lesson about it, but please remember that they will buy it at the par value of the instruments after the maturity period. So the bonds can be classified into tax saving bonds and regular income bonds. Okay. So why do company goes for this thing as we talk, bonds? So rather than selecting other methods of raising money. See, I also said bonds are also issued by companies and financial institutions. Okay, and companies usually there is some reason that why companies issuing these kind of instruments called bonds. Why they are doing that? Instead of raising that money, they could go to the bank and lend loan, or they could issue stocks. Okay, so there are other methods also to raise money, but why companies prefer to issue bonds? Okay, because bond financing is considered as a less expensive one than raising money from equity, because for equity you have to do a lot of things. Okay, like advertisement and other things, there are a lot of things involved. So it is easy for raising money through bond. That is why companies prefer, generally companies issue bonds. Okay, and it also see, when somebody buys an equity instrument in the capital market, it will incur that the company has to give the ownership, dilute the ownership of the company. But in case of a bond, it will be no such thing. Okay. Again, why bonds are preferred in terms of not to bank loans? Why the company is not going for bank loans, no, rather than bonds, no? There are several advantages in bonds over bank loans, because these bonds could be structured in many ways with different maturities. In fact, bank loans will be more structured by banking authorities about and conditions, but the bonds could be set as per the wishes of the issuer, that is the company. Okay, so there are such merits. That is why a bond is preferred over equity or bank loans, which are also capital instruments. Okay, getting a bank loan is also a kind of capital instruments to do a business, like, and also buying a equity market is buying issuing a share to raise money is also a kind of capital instrument. Okay, so I have given here what are the different types of bond. So government debt securities is there, that is the government issued securities. It is known as G securities. It is fixed for a period. So some of the examples, no, Kishan Vikas Patra, National Savings Certificate, a lot of things. I have given a few examples. Okay, and please remember, both the state and central government will issue long-term securities. Okay, but the long-term securities issued by the states are not called G securities. They are called state development loans. Okay, state government also issue an instrument, a bond type of instrument to raise money for long-term period, but they are not called government securities. Only the central government issued bond are called government securities. When the state government issues, it is called state development loans. Please also remember, when the central government issue for a shorter period, that is less than 1 year, it is called treasury bill, that we learnt in the previous lesson. Okay, I hope you remember that. Then banks also issue bond. In fact, fixed deposit is a kind of bank issued bond. We learnt in the previous class in the money market, that is there is the thing called certificate of deposit. The difference between fixed deposit and certificate for deposit, no, see, in both cases the investor is investing some money in the bank. Okay, in both cases there will be some period after which that money is got back, and in the both period there will the bank will give them some interest. They will pay some interest to the money investor, the investor. Okay, what is the difference between the fixed deposit and CFD? In fact, we discussed this even in that money market class. The difference is the fixed deposits are not transferable. That is, if you go and deposit in a bank, only you could get that amount later. Okay, in case of CFD, you could sell that CFD to somebody, that is transferable. Okay, so fixed deposits are not transferable, and generally fixed deposit are the least favored instrument by investors, because there will be lesser interest rate and it's also not transferable like other securities. Okay, so generally fixed deposit will be the least favored for an investor. Okay, but people who want security will that is their their investment to be safe, will invest in fixed deposit. Okay, similarly companies also will issue bond to raise money. In fact, the types of bond that the companies issue now are categorized into secured bond and unsecured bond. So the secured bonds, no, these are all backed by the collateral of a company. For example, If a bond, if a company issues a bond by secured means, it means there are some assets attached towards that bond. Okay, so so in this case, the investment is safe. When a company issues a secured bond, no, and a investor is investing money in that bond, in that case there is some security. Whenever there is security or safety for the investor, there will be less interest rate. Okay, please remember this point. Whenever somebody is investing in something which is safe, there will be less risk, there will be less returns. Okay, so the secured bonds will have less returns. The unsecured bond, also otherwise known as debentures. Okay, the second category is unsecured bond. It is also known as debentures. The company issuing unsecured bond. Okay, it is risky because it is unsecured. There is no collateral backed by it. Okay, if the company is tomorrow, if the company that is issuing that bond from you to collect that money, and if tomorrow that company go bankrupt, no, you are under risk. Okay, so debentures. So debentures are unsecured bond. They are also issued by company to raise debt capital. So please remember, all debentures are bonds, but not all bonds are debentures. Some bonds are not debentures. These kind of things you need to know if they ask the question tomorrow in civil service prelims, a conceptual question. Okay, because a bond could be unsecured bond and unsecured secured bond, and the secured bond will not be a debenture. Okay. Bonds, debentures are in two types. One is convertible debentures. That means, see, a company can raise money by issuing securities. In fact, we will learn next securities. A company could raise money by issuing security, by issuing shares. Okay. Similarly, a company could raise money by issuing bonds. The bonds, unsecured bonds, is the debenture. Okay. The difference between a debenture and a security share is, in the share, a person will get the ownership of the company. Okay, and a share is a permanent capital for the company, the issuing company. For example, if you invest in a share, no, you cannot claim back the amount. Okay, so long you want to be an investor. Of course, you could sell it in the market and okay, but it is, that amount will not be returned to you. Okay, but in case of debenture, the company has the right to, company has the obligation to repay after that period. If the debenture is issued, for example, a company is issuing a debenture saying that 10-year period. After the 10-year period, the company has to purchase the debenture back from the investor. Okay, here comes these two types, they call convertible and non-convertible. What is convertible? Suppose the company, after, for example, a company has issued a debenture for 10 years and the 10 years has ended, and now the company is not having enough money to repay the debentures. No, if the company is already issued the debentures in the convertible debenture, no, what the company can do, or what the investor could do is, they could convert this debenture into shares. Okay, the amount of at the market price, at that price, if the share is 1,000 rupees and I have bought a debenture for 1 lakh rupee, no, I will get like 100 shares of that company. Okay, 100 shares. Okay, so a debenture that is converted to shares. So this had to be this agreement should be made very early when they are selling the debenture. When they are purchasing the debenture itself, they should purchase a convertible debenture so that in future they could convert this into shares. Okay, The second is non-convertible, which cannot be converted. In that case, the company has to purchase that bond at the end of the time, and also the investor also will get it back. He cannot convert it into equity of the capital. Okay. So please remember this point. This is not a permanent source of capital. It could made into a permanent source of capital by way of convertible debentures, but that too up to the investor. Okay. So the company is promising to repay the loan amount after the period, maturity period, after say a certain period. So it has to purchase it back. Okay. So bonds are generally considered more secure than debentures. Okay, but why people prefer debenture? No, the interest are lower in bonds. Okay, so unsecured bonds, secured bonds is called as bond, and unsecured bond is called as debenture. Okay, please remember this difference. So as the name itself implies, secured bonds will get low return, but debentures will get more return. Okay, more interest, it will carry more interest. Okay. Also remember, if the company bankrupts, no, if the company tomorrow, if the there is some loss or the company is closing, no, in that a case, since the bondholders are secured loan, it has collateral with some asset, no, the bondholders will get first preference in liquidity of the company. That is, if the company is tomorrow closed and the company is sold, the bondholders will get the first money out of it. Okay. In fact, debentures will get only later. In fact, the shareholders know, those people will get third. They are more risky than debentures. At least debentures holders will get second. Okay, but more safer person is the bondholder. Okay. So the debentures holders know will get periodical interest. Okay, they will get a regular interest between 1 year, every 1 year, or every 6 months, like that. Okay, that will be according to the terms. But the bondholders know they will get the accrued payment upon completion of the term. Okay, at the end of that period. So remember this point. These are all the difference between bond and debentures. So what are the pros for investor? As I said, no, in the debenture, the investor gets a fixed rate of income. Okay. So generally it will be half yearly. Okay, and it is also tax deductible, and debentures are generally considered safer to investment when compared to equity, not when compared to bond. When compared to bond are more safer, but when compared to share equity, no, debentures are more safer, because when a company is tomorrow collapsing, first preference for that asset will go to the bondholder, second only it will come to debenture, third it goes to equity holder. So in that case, they are better than equity holders, but they are not below the bondholder. Okay, please remember this point. And also, they don't get voting rights like the equity holders. Equity holders will get voting rights. Okay, and they also have no claim in the profit of the company. They will get only the principal amount after the period and regular fixed rate of interest. Okay, so they have no saying in that company. Okay. See, here I want to talk about another thing called companies raising externally. Companies also, in fact, this I should not discuss in this capital market, but companies raise money from foreign countries also, externally also. Okay, why are companies borrowing externally? Okay, that is a big question. Why companies have to borrow externally rather than borrow in India. Okay, one reason is, see, our government uh, before capital market becomes stronger, they actually they borrowed externally from other countries or from other places. Okay, in fact our government borrowed a lot externally. But once India's capital market becomes stronger, in these days our government is not borrowing externally much. In fact, they are not even borrowing any much. Okay, they are, because for them the local market is here. That is the capital market. They could issue securities and bonds, and they could raise money. Okay, treasury bills and other things. So the government, since a vibrant capital and money market in India, they are not borrowing externally. Since they are borrowing more in the local market, this left very little amount for the industries, companies to raise in the capital market, in our capital market. Okay, so the companies in India, they are looking for, they are going for external commercial borrowing outside India. Okay, but the problem for the companies is, okay, here I want to discuss about one bond, so that is why we are going into this topic. Okay, for the problem for a company raising external commercial borrowing is, see, for example, if a company in India, if it wants to raise some money from London, right, or USA, if it wants to raise some money from USA, in that case it could raise money from for example, say if it is raising $1 lakh from USA by issuing bonds. Okay, in that case it has to pay, it will get 70 lakhs if the price rate of rupee is to dollar is 70. Okay, $1 is worth 70 rupees. In that case he is getting 1 lakh rupee. Dollar means he is getting 70 lakh rupees today. Okay, and he is getting that loan, for example, for 5 years or 3 years. And after 3 years or 5 years period, if the rupee value has declined to dollar value, for example, if the rupee value has gone to 75 rupees, I bought today at for 70 rupees, so I got 70 lakhs. But when I am repaying, I have to repay 75 lakhs because the exchange rate has the rupee value has weakened. I have to pay the dollar value, I have to pay 75 lakhs. I hope you understand. I have to pay $1 lakh, but $1 lakh is when I'm raising the loan just 70 lakhs, but today it is 75. So when I'm receiving, I got only 70 lakhs, but today when I'm paying, I have to pay 75 lakhs. Okay, so to avoid this problem, to save the companies, our government and RBI come up with the external commercial borrowers for the companies a new type of instruments called masala bonds. Okay, see, generally in the external commercial borrowing, they buy in the dollar denominated, that is, they will buy at the dollar value. But in the masala bonds, they will buy in the rupee denominated. What is that? In this case, they will get they will sell the bond in Indian rupee value. Okay, in this case, if they are raising 1 lakh, in this case they are raising 1 lakh in the foreign market, right, but through the masala bond, it is the rupee denominated bond. Okay, and this could be raised both by the public sector companies and the private sector companies. In fact, these kind of questions are asked in the prelims examination. That is why I am discussing this. Okay, when it is if it is issued, these bonds are sold in the Indian rupee, what it means is, if tomorrow Indian value declines, the burden will fall on the investor, that is the person who is investing in the USA, okay, somebody who is investing, that person will bear the brunt of the fall in exchange rate. For example, today I am raising 1 lakh rupee, okay, tomorrow I am pay 1 lakh rupee, but tomorrow the rupee value has declined and they will pay me in dollar for the 1 lakh. If I want 70 lakhs, they will pay 1 lakh. Tomorrow, since 70 lakh will be less than 1 lakh, of 1 lakh dollar, I will be paying only lesser than 1 lakh. Today I got 1 lakh dollar, tomorrow I will be paying lesser. I hope you understand. It is the reverse of the previous case. Okay, in the previous case, when there is the dollar denominated bond, the Indian companies will be the losers. In the masala bond, when it is issued by Indian valued rupee denominated bond, hence if the exchange rate our rupee value declines, it is benefit for the Indian companies and it is loss for the foreigners. Okay, so you might ask me, why then that foreigners will invest? In fact, they will invest earlier and now in the masala bonds they won't invest. Still they are investing. Why? Because still the interest rate offered by the Indians, Indian companies, is larger than that is offered in the foreign markets, foreign capital markets, the amount that they get. Okay, so they are still preferring to invest here. So the kind of interest offered by the Indian companies are higher. Even if they offer 6% interest, it is higher for them because their country offer only 2%, like that. Again, why Indian companies are looking for foreign market to issue bonds rather than they could invest interest here? One reason is they could not invest here because government is getting more. Another reason is, in the Indian market, if they have to pay interest up to 7 to 9%, but in the foreign market they could pay even lesser. That is what I said, because in the foreign market, for them, the foreign market offers only 2% or 3%. So if the Indian company offers 5%, 6%, they are willing to buy us. So again, the Indian companies save some amount, that interest. Okay, I hope you understand what is masala bond and why that is sold in the foreign markets for raising money. This is also a capital market instrument. Please remember, this is a company issued bond in the foreign land, okay, not in the India. Okay, so this was introduced in September 2015 by RBI, and initially before September 55, in the first masala bond was issued by the IFC, International Finance Corporation, which is the International Finance Corporation, which is the arm of World Bank. In fact, this question was asked. Okay, in fact, IFC is the one who would be issuing this kind of bonds. Okay, and these bonds are listed in the London Stock Exchange. Okay, again, this is very important. These kind of facts are very, very important. Then there is municipal bond. It is nothing but local institutions like municipal boards and any other local institutions issuing bonds to raise money. Okay, and these are all could be called as the debentures of the municipal bodies. Okay, since they are meant to finance their projects like building roads, schools, airports. Okay, so the local bodies can also raise these kind of bonds. So that now there is the securities market equity. Now we will next see the equity, which is again an instrument of the securities market, but we will discuss this in the next lesson. Okay, in fact, we will discuss two other things, both shares and derivatives and other instruments also there. We will discuss all those things in the next lesson. Okay, please keep watching this for the next part. You will get a complete picture. Okay, in fact, please remember, in economy there are lot of forward and backward concepts. For example, I have to discuss you about bond, comparing it with equity, but i I will be discussing equity later. So sometimes you might not understand a concept when I'm saying the first concept. So you have to be very patient to learn in economy, so that you will get the concept once you learnt everything. So you won't understand economy very properly if you don't have any foundation in economics in the school level or college level, if you are not learned properly. So please be patient to understand these concepts. It will come to you. You have to be patient. Initially you might be a little difficult to understand when I am discussing something without even explaining the other thing, right? When I am discussing bond, I have not yet described the features of equity, but I am discussing about bond, comparing it with equity. So that kind of problem is there, but please continuously watch everything. Once everything goes, you will identify. Okay, it will take some time and effort from yourself also to understand everything. Okay, please keep watch my next chapter.